Welcome, everyone, to our webinar on Life Science Corporate Venture Capital. I'm Kirsten Loita of Osage University Partners, and I'll be one of your moderators today. Corporate VCs have played a crucial role in financing life science companies for decades, but have you ever wondered what, if anything, makes them different from institutional venture capital funds? In today's webinar, we will talk to a panel of investors at industry-leading life science-focused corporate venture capital funds to learn more about their strategies, investment criteria, and how they measure success. We encourage you to submit relevant questions, not unrelevant ones, relevant questions throughout the webinar. If you would like to submit a question at any point, please use the Q&A feature on your toolbar. Usually it's at the bottom over on the right-hand side. Many of you actually did submit questions beforehand ahead of this webinar, and some were specific to university startups, and we'll be addressing those as well. So thank you for those of you who submitted early questions. The slides and recording of this webinar will be available on OUP's partner portal, and a recording will also be publicly available via our YouTube channel. Once you are in the partner portal, which you need to register for if you're at one of our partner institutions, if you've not already, you'll find a downloadable presentation deck and a video link on the webinars page, which is under the Startup Resources section. So starting off, to give context to our discussion on CVCs, Stephanie Stamen, a principal on OUP's life science team, will present a few slides on the state of healthcare investing among life science CVC funds, followed by introductions and a discussion amongst our terrific panelists, who I'm really looking forward to hearing from today. But Stephanie's going to start us off here. Stephanie?
Great, thank you, Kirsten. So before we dive in on the specifics around corporate venture investing, I just wanted to take a moment to acknowledge what an unusual and record-setting year 2020 has been in the life sciences. The first 2 quarters of this year saw the greatest investment ever for VC-backed companies, and this is despite the impact of COVID-19. And I have not yet seen the numbers for Q3, but I believe biopharma investments are on track to exceed the records that were set in 2018. And coupled with, or perhaps driven by, a robust IPO market and strong post-IPO performance, it's just been an incredibly strong showing for the sector in almost all respects. The next slide, please. So now I just want to talk a little bit specifically about corporate venture activity. And I think when you look at the slide, it's immediately clear that these investors are very, very active. So as you can see in the figure on the left, the investment activity of the most active CVCs meets, or in some cases exceeds, that seen for institutional VCs. And these investments tend to lean a little bit on the early side, with the most activity seen in Series A and B rounds. And in fact, CVCs participated in 30% of all biopharma Series A rounds in the first 2 quarters of this year. So those are just a few quick stats. I think that these numbers really show the enormous impact that these investors have on the space. And I know that all of you did not log in today to hear me talk about statistics. You want to hear from our panelists. So I am thrilled to be joined today by 3 fantastic VCs from different corporate venture funds, some of whom I have known for years. Jason, we won't say how long, and others that I have had the privilege of working with more recently. So I'm going to have each of them introduce themselves and tell us a little bit about their background. Rana, do you want to kick us off with your intro?
Sure. So I'm Rana Al-Hallaq. I can kind of go back. I'm not sure exactly how far back to go. Let me start with my undergrad in biology from Hamilton. I have a PhD in neuroscience from Georgetown. I was going down the academic route, did my postdoc at NIH for a number of years, and then moved into industry. And that was first into clinical development in the psychiatry department at Forest. And this was a big transition for me, but it was kind of my move then into business development there. So kept moving closer to the business side. Forest has become Allergan and is now part of AbbVie. 5.5 years ago, during one of those transitions, I came to Pfizer and had a couple of different roles, starting off working with our early stage neuroscience portfolio, which we've spun out into Cerevel, working on strategy alignment in that role, and then moved back into business development working across therapeutic areas, and about 2.5 years ago joined the Pfizer Ventures team. The Pfizer Ventures team, we sit under 2 different parts of the organization. My side of the organization sits under BD, so it was a move within BD. And we are investors, you know, we focus mostly on therapeutics. We do make some investments in other areas that support our business. And we generally, I would say kind of our sweet spot is investing in Series A. Sometimes we invest in seed, sometimes we start off in Series B. And we support the companies that we invest in, you know, through exit. So often we'll participate in the IPO and then we'll step away. We, you know, kind of initial check sizes, just to give you a sense, are between 5 and 10 million. Of course, for a seed, that might be less, just given the needs of the company. And we have a portfolio of about 50 companies. So it's actually, you know, 50 different investments. So it's actually a pretty robust portfolio. You know, my manager often says that, you know, we have basically a pipeline within our portfolio for Pfizer Ventures, just similar to what Pfizer has in development. So I think I'll stop there and happy to answer any questions as we go.
Great, thank you. Jason, do you want to go next?
Thanks, Stephanie. I really appreciate the opportunity to talk to our friends in the tech transfer side and Osage for organizing this and a terrific panel. I'll try not to bore you. I'm much less interesting than Rana, but I began my career as a banker, all biotech related, did a PhD in genetics and immunology, ended up spending a summer doing an internship at Flagship to learn company creation, cut my teeth in another fund in Boston called Atlas Venture, went to one of the portfolio companies, which is now Translate, which actually has a relationship with Sanofi, which is a wonderful thing for both sides of that, and joined Sanofi Ventures, or what is now Sanofi Ventures, about 7 years ago to help relaunch the fund. We can talk a little bit more about, you know, who we are, and I think we can try to weave it into some of the questions. But ultimately, you know, we see ourselves as a strategic tool for Sanofi, right? So often when I've spent my young career outside of big pharma, you'd have our portfolio companies, you know, talk to J&J, Roche, Pfizer, Sanofi, and you get the answer of, you know, we love what you're doing, you know, but come back with more data, right? And so we get to be the answer to that as a bridge, ultimately, to we hope can be a pipeline opportunities for our parent company, but we want to be able to invest, build that relationship with the board, and try to position us as a potential partner of choice down the road.
Great, thanks, Jason. And Marion?
Yes, hi, I'm with JJDC Johnson & Johnson's Corporate Venture Group, and I have a PhD in pharmacology and started my career in R&D at Centocor and came into J&J through that acquisition. And after heading up a group within R&D, I transitioned to business development, which is somewhat which is a more normal path, I guess, within pharma, and then to the corporate venture group 7 years ago. We invest at all different stages, from seed convertible notes that can be very small or very large to Series A, B, and beyond. And we invest globally in 3 sectors: pharma, device, and consumer. And there's 12 of us who invest, and we deploy about $500 million in capital every year. We also do PIPEs, which is investments into publicly traded companies, but those are only transactions that support business development deals. So, and we've been around for over 47 years. We're actually we are the oldest healthcare venture capital group in existence. So. Thanks for the invitation.
Great, thank you. Thank you all for being here. So we're going to jump in on the questions. I just want to remind everyone that if you have any questions you'd like to submit, there's the Q&A button on the bottom of your screen, so you can feel free just to send those in live as we go. And I'm going to start with a question I'm actually going to have all 3 of the panelists answer, because I think it's so crucial to understanding the difference between an institutional investor such as OUP versus a corporate VC, and that's the relationship to your parent company, and whether or not you're considered, you know, independent from them, or if you're actually investing off of their balance sheet. So I'll start off with Jason on this one.
Great. So the way I think about us is ultimately, we are strategic, right? And so unlike some of our other peers on the corporate side who are financially motivated, we're not, right? So we manage our fund like a fund where we're evergreens. So any proceeds that we have from sale of a company or an IPO, we recycle that capital. But effectively, we view ourselves as a strategic fund for Sanofi, and so we're very closely tied into the organization. And I think with that, when we make an investment, it's not just dollars, right? Stephanie, you pointed out of how robust the capital markets are right now, right? And so I think we view ourselves as trying to bring more than just capital, but it's access, if the portfolio company wants it, to our parent company and help on the clinical or preclinical side.
Great, thank you. Marion, how about for you? Is it similar or a little bit different?
Yep, so we are part of J&J, and so we invest off the balance sheet, and we are J&J employees, so it's not a separate entity. And we, for us, the goal is to expand J&J's portfolio, and so our mandate is first strategic, and second financial. And that's I think it's very, very similar to Jason's mandate. And we do require co-championship of R&D for what we invest in. And that has its pros and cons because there's a lot of things, if I were financial VC, that I would love to invest in, but for a host of reasons, it might not just be appropriate for the R&D folks. But that's important to us because as we at JJDC call onboard companies or assets into, which is really our goal for what we consider success. If we don't get that buy-in at the beginning, it's hard to get it at the end. So that's why we require that co-championship.
Great, thank you. And Rana, how about for Pfizer?
I think it's not too far off from what Jason and Marion said. So we have two objectives, strategic and financial. I think financial because we need to stay alive in our organization, and so we don't want to be losing money for the organization. But we are a strategic fund. We do try to the idea is to advance areas that may be of interest to our internal organization. And the exception to that is that we also invest in neuroscience, which we aren't actively engaged in internally, except in the rare disease unit. So, generally what we do is I think we also try to make sure that we're aligned somewhat with our strategy, maybe one step ahead, one step removed. I think Jason said, helping get those experiments done or get the company and the program to a certain stage, so then you can, have other kinds of conversations, partnership conversations. That's one of the things that we do. And then we keep an eye out for areas of emerging interest that we may want to help support in case that's an area that we would like to go in the future. So pretty similar.
Yeah, and I think that.
Sorry.
Oh, sorry. Go ahead.
All I was going to say was I actually think that goes well into actually one of the first questions we got was whether your investments have to align with your company's existing pipelines or if you can invest in other areas. So Rana, I think you kind of just answered that, but we'd love to hear from each of you on that, because I think that's one of the things that people often are wondering about corporate venture capital groups is, does it have to really align with exactly what you're doing right now? Or are you thinking about future areas as well? Rana, you want to go first?
Happy to start. Yeah. Sure. Yeah. And I think we are thinking of areas that we may be interested in, and so they're not exactly a fit into the pipeline, but we do like to be somewhere in the scope of what we're interested in, and those are pretty broad buckets. So oncology, or information immunology, and then some nuances under that. But it isn't a direct fit into our existing pipeline in all cases. In some cases it may be, but we also like to diversify that investment and sometimes be maybe one step removed from there.
I mean, same for us, I think. Okay. Go ahead, Jason.
So I was going to ask a question. So Marion, if you look at the past couple of years, of the investments you made, how many have ended up in partnerships, acquisition, or relationships with your parent company?
I don't know exact number. I mean, I'm guessing, I would say, less than half, but a decent number. And in some instances, the equity comes with a partnership or collaboration, or sometimes a partnership and collaboration feeds into an investment. And then ultimately, for example, some of the big ones for us, like in the device side, Auris Surgical, I mean, we acquired that. And we had been early investors in that. And that's sort of, that's the model working at its best, where we really helped to build and scale and craft the company into something that we ultimately just acquired the whole thing for $6 billion. So I think, but you know, it doesn't always turn out that way. I mean, I think there are times when the original thesis is not where the company ends up. I mean, that happens a lot of the time. So when those pivots occur, you know, we do our best to continue to be financial investors so we can sort of shift from one to the other. I mean, it's a great question. We'd love the number to be bigger, and we continue to have a lens to be able to increase that yield. But you know, we really have to follow the science.
Right. Sure. I think we're in the same place. Yeah. Sorry, I was just going to say, yeah, you know, last year we acquired one of our portfolio companies, Theracon, but it's not something that happens very often. And we do have a number of partnerships, and we have a lot of ongoing discussions with our portfolio companies. But to actually get to something like an acquisition or a major partnership or, you know, licensing deal, it is not a common event, I think, given the size of our portfolio. Yeah.
Yeah, and so I was going to highlight, so I think one of the things for us, you know, we work closely with our colleagues on the business development side, but we're really a separate tool. So I think unlike, you know, J&J, I think you'll have, I think, much more, right? I think even there's some portion of the dollars have to come from R&D, right? Or there's some relationship or sponsorship. And so for us, we really try to go and think about, you know, we're never going to invest in areas that are where Sanofi is not going to be, but we love platforms and technologies that would be adjacent, or, you know, the old Wayne Gretzky line, go to where the puck is going, not to where it is. And so we like to be able to play in that area that will make sense for the, you know, the future portfolio and strategies of our parent company. But we really, you know, we would never do an investment as part of a BD deal. That would always be done through BD.
Great. So my next question, I think, is one of my favorites. I think it's one of those areas where there can be a lot of misconceptions about how corporate VCs think about investments, and that's around valuation. And so I think many folks feel that you are not valuation sensitive and are willing to pay a higher price to ensure access. So how true is that? How do you really think about valuation? And I'll have Rana start this one off for us.
So that's an interesting question. To be honest, I think I just heard that for the first time this year. I didn't realize that was a misconception. So we are valuation sensitive. We are financial investors at the same time. So we, you know, again, we have the same, I think, discipline as institutional investors. We do, you know, perhaps grant some level of you know, we might attribute some of the value to the strategic fit. So there may be something there, but I don't think that we are valuation insensitive. I think it's really, we are very, you know, I'd say in that sense, really function as an institutional investor.
How about Marion? How about for you?
I totally agree. I think it's a myth. I think maybe why we invest, which has to do with the strategic interest, is maybe something that is a black box. But I think the valuation piece is totally not correct. And I think we would cease to exist if we didn't provide a return to J&J. And, you know, it's our duty to our shareholders whose money we are investing to get a return on that. So, and I think the other piece of it is, if you think about us being the exit, being valuation insensitive isn't smart for that orchestration either. So anyway, so I consider it a myth.
Yeah, I think so as well. I mean, we've invested alongside a lot of life science VCs overall, and that includes corporate venture capital groups. And I would say I not to see that they are paying higher prices for deals. So it's good to debunk that myth here. So we have one question that came in on leading deals, and so whether or not you prefer to lead deals or come in as part of a syndicate, and also whether or not you require a board seat. Jason, do you want to take that one for us?
Yeah, no, I think the short answer for us, we do like to lead or co-lead deals, and we do, if not always, I would say the exception, but we always will take the full board seat. And we found that it is ultimately because of the way we can be most impactful strategically, investing in companies or seed or Series A of the company building, is when you're there at the board and really helping drive strategy and making the right connections.
Great. Marion, how about for?
Yeah, I think the same for us. I think we're also open depending on the check size that we're writing, either how much we want or how much we're allowed to. We would also be open to an observer seat to at least sort of be around the table. And I'm jealous of my colleagues in consumer and the medical devices, because they tend to lead with JJDC a lot more, and they actually get rights with leading those deals. And it's, I think, just because there's, fewer investors that are in some of those spaces, and at least in the device space, it tends to be sort of like invest to onboard or invest to acquire. So we do it a lot more. In the pharma space, I find us doing it maybe a quarter, a third of the time. So there has to be a compelling reason for us to do that work. But we do lead up, some of the time. I mean, that being said, it's important for us to syndicate. So that's a whole other question for reasons that have to do with accounting and other things. Although I will say using convertible notes gets around that a little bit if you don't have ownership. But it is something that we will do on occasion.
Yeah, and Marion, that raises an interesting point, and I think also touches on what might be another myth about corporate venture capital, is this idea that you require special rights in order to make an investment. And so it sounds like you might want them in some cases, but do you require anything like a right of first refusal or negotiation?
In most farm investments, we don't. I mean, I think you don't even ask because it makes you look unsophisticated, especially like we were in companies. I mean, Jason and I are in one together where there's multiple strategics. So you would just never ask for rights in that instance. And I mean, that being said, there are some instances where we do have rights, but oftentimes it's because we have some sort of leverage to be able to get those. But the reality is, no, I'd say in most of the instances in the pharma deals, we don't have rights.
And Rana, I can see that you're nodding your head, so it seems like that must be a similar answer then for you as well.
Yeah, that's right. Yep. Yeah, and I think something that Marion mentioned earlier, we do, we in Pfizer Ventures also support equity deals, any deals BD deals that include equity. Those are separate from ventures. And sometimes I think people are confused when they see the venture team in a BD deal. I think they're confused where maybe the investment is coming from. I just wanted to make that distinction. Same people, different, approach, different fund altogether, different money.
Right, and Jason, do you find, is it the same for Sanofi, or do you have a requirement or a preference or any sort of rights when you invest?
We wouldn't ask for it for a whole bunch of reasons. I think a lot of them say.
Yeah, I think we see it very infrequently.
Well, I think it's also right, as I think about your question around valuation and sensitivity. I guess I think of it in the same way. How do we position our portfolio companies for success? And two things, right? If you overprice around, you're not going to be able to have the appropriate step-ups, and others come in along the way as the different buying inflection points. And so to me, yes, we can be more flexible on price, but ultimately it's not about us, it's about how we position our companies for success. I think that also translates into how we think about ROFRs, ROFINs. It's not the right thing for our portfolio companies, and so we don't ask, nor would we.
So I'm going to combine we've been getting a lot of questions from the audience, and I'm going to combine two questions because I think we can do that. So the question is, what are the considerations or prospects should weigh when evaluating venture capital investments from one of your organizations versus perhaps what's considered traditional venture capital? And then the one that kind of goes along with that is that, do you find that potential portfolio companies are more or less eager to bring on a corporate VC versus a classic VC? So, what are the differences people should be considering, and what do they need to think about what the pros and cons are having a corporate venture capital group associated with their investment? And Jason, I'll have you start off.
I mean, you get to work with Marion and Ronans of the world. How could you not want that?
Exactly.
I mean, look, right, the people you should ask are CEOs, right? And they can tell you why. Again, I think about it as not just one person, but how do you build the right syndicate, right? And I think as part of that, having strong institutional investors, I think strong corporates who have interest in area, in a space. So I'll use an example of a company called Chimera, which we invested in back in 2018. We're able to foster the right relationships. This is in the protein degradation space, but very focused in the I&I immunology space. Foster relationships and had a transformative partnership announced this past summer. And so I think if you ask Nello, I think he would say, having, and he had several strategics, but having us around the table was ultimately very helpful to them because of the fostering relationships, but also having the strong, Atlas and Atlas-backed company and built was also very helpful. So again, I think about whole composition versus just one-off, and I think with 30+% of most of the Series A's that we do having at least one strategic, again, I think again, I'm biased, but I think it's a good thing to have them around, especially those around this table right now.
Right. Marion or Rana, is there anything you'd like to add to that?
I would just add, I think that, I think we've touched on this a little bit, but we really come, we come with the full kind of force of our organization behind us and have been able to really leverage that, I think, for our portfolio companies. So I think it's, beyond the capital, we if as needed, we may have somebody from our CMC group or, our toxicology group take a look and be engaged with the company as much as the company might want. So I think that there's that advantage. And I would, I do think that to Jason's point, I think it's really important to mix, skills and kind of, what your syndicate is bringing and make sure you've covered all aspects. I think having a strategic is a good part. And just maybe one final point, I think, beyond thinking about strategic versus institutional, it's, what is the track record of each investor? Have they stuck with the companies throughout? I think it's more maybe on an individual investor by investor basis.
Yeah, I agree. And I think, yeah, good.
Oh, no, go ahead, Marion. Go ahead.
No, and I think it's important to tailor your outreach in terms of what stage you are, how much capital you're raising, and then sort of curate your list from there. I mean, I think one of the nice things about corporates is we do invest and come in at all different stages, but other venture firms are only going to cut like very large checks. So, they may not be the first people that you reach out to. And so, and I think also, as Jason mentioned, it's so much about relationships. And a lot of the investments that I've had a very easy time getting approved, it's because the people at Janssen who are making the decisions about that co-championship have worked with some of these CEOs and CSOs in the past, right? And they really trust the team, the integrity of the science, the innovation, the creativity, and those folks to be able to deliver on a drug discovery program. So I think that trust and relationships really go a long way also.
And I would add to that, so from the institutional standpoint, that having a corporate venture capital group join the syndicate, I think is always a value add. And I think that most investors would feel the same way. As Rana said, it brings the full backing of your organization, and these are all top tier prominent organizations. And so we know that the strength of your diligence is based on that, and it provides a lot of external validation too in many cases. So if it's something where maybe it's novel science, where some folks might struggle to get comfortable with it, being able to say, well, this organization thinks that there's something here, I think it lends a lot of credibility to an investment. So it's for me, I think, always a value add to have one of you join the syndicate for sure.
I'm gonna stop talking and let Stephanie take the rest of my minutes. Thank you.
She's the advertisement for us.
So we have a number of other questions, and there's ones that involve early stage funding, follow-on rounds, confidentiality, and exit. So I'm going to kind of go into order that like a actual how investment order would work on each of these. So I'm going to ask about the seed funding first, is how you actually identify your seed stage opportunities And at what stage of development of the startup do you actually invest? And do you have, and I know this is really important to a lot of our universities, is do you help with them with the leadership teams that the company ends up having? And Marian, let's start with you on this one.
We have in the past. That being said, we don't have the as efficient machinery as some of the Boston-based venture groups who have a stable of people that they can sort of pull from. For us, we really recruit from the outside because we at J&J cannot be an agent of an entity that's not ours. In other words, we cannot negotiate for NewCo. We can't hire into NewCo. So we can recruit folks that they're sort of entrepreneurial, like on the outside, or even let's say lawyers that will act as the agent and then be able to help the NewCo form that way. So we have done that, but usually it's because it's related to something that we're externalizing or strategic assets that we are interested in. For most of the other more academic spin-outs, it's easier for us to partner up with a venture group that has more of these NewCo formation capabilities. But our plan in the future is to do more of this, to have J&J do more of this in a more efficient way. So it is definitely something that's possible.
I'm sure that our universities are encouraged to hear that, honestly. Rana, did you want to also respond to this?
Yeah, I think we're in a similar position in that we have done it before, but we don't have the machinery, as you put it, Marian. So I don't think that we're the right people to lead that, and so we really look to others in the syndicate who are able to do that. We're happy to come along and to do what we can, but I think we like having someone else who has boots on the ground and really can work very closely also with the company. So we also sometimes look for actually just geographical fit. Somebody, if there's an investor nearby who can help that company get up and running. There's a heavy lift at the very beginning, as everybody knows. So we're not the ones to take that on our own very often.
And Jason, did you want to just address the sourcing part of that question about when you're sourcing those seed deals?
Yeah, I guess I don't view us any different than institutionals, and I even was looking at the participant list when we're signing on. I see John from Yale, who, hi, how are you? We're actively engaged and work closely with a lot of great, I'm sure a lot of the great tech transfer offices that are on this today. But I don't see us any different than institutionals. We did a couple seeds this year, work on another one now. I do think bandwidth, right? If you just look at our relatively lean team versus some of the other larger funds, of what we can do, so we're selective, but in areas that we want, we're no different in terms of the relationship building and the early stage seeding from our peers on the institutional side.
Right. So the next question, kind of down this pathway of the investing, is what's the confidentiality walls that exist between your organization and your parent company? And Rana, do you want to start this one off? Because I think this is something that gets to be of concern to the companies themselves.
Right. Yeah. I think anything that comes into Pfizer Ventures, we are a very small team. We're 7 people. We are experienced in being outwardly facing and understanding how to firewall. And so we start off with a non-confidential discussion. If we think that there is a conflict, we may not go farther if it's something that's a conflict that we don't think we can manage. So we're very sensitive to that. But then if we do go into confidential discussions, we've just navigated it, I think, for years. We don't need to engage people in that group. If we're looking into diligence, we're able to use third-party reviewers, external to Pfizer, so that we don't have anybody internally. So we have different tools that we're used to using, and I think it's something that we realize that I think companies are often nervous about, but I think just having some conversations usually assuages that. It's something that happens all the time. We have a lot of experience managing that. So,
yeah. And I'll just add, I think this is a critical component to talk about, because from our end, there's a complete separation. And once we make an investment, there are zero materials shared internally outside of our legal team and whatever that would be needed. But with a separate drive that no one else has access to, access to, and our fiduciary responsibility has to be to the portfolio companies. And so we are abundantly clear of the firewall that's just set up once an investment is made. That, I mean, our team goes out even so far as to if a meeting is getting set up, we have the company send all materials. We don't want it, we will not forward anything. And I think that's an important thing is, it's partly the trust. And I think once we build that trust with the CEO and a management team that exists, but it's them knowing and realizing that any information, once you make your investment, has to come and is shared from the portfolio company. So there's a significant firewall. Same
with us. With the technical diligence as we're going in, we get permission. We make clear that the R&D guys will do some of the technical diligence, but once the investment's made and we're on the board, like the wall slams shut. Even during that original negotiation, things like valuation, cap tables, I do not want the R&D or the R&D BD folks or finance folks knowing that. So anything that would advantage them in doing a strategic deal is something that they shouldn't have. And so we're, and by the way, if that wasn't the case, people wouldn't co-invest with us, right, guys? I mean, so, and there really is that trust, I think, at least in the Boston ecosystem, that we're really viewed as investors rather than arms of the R&D organization.
Great. Thanks. That's really helpful, and I think very reassuring. It'll help a lot of people to know about that line between your organizations and the parent organization. So the next question is about follow-on rounds, and actually I think this may be more of a general just venture capital question, but so Stephanie, chime in as well. But there are cases where venture capital groups, they invest in one round and then they decide not to participate in follow-on rounds in a portfolio company. And how does it, so the question was, does it make it harder? But if it does make it harder, which sometimes I think it does, how does it make it harder potentially to raise the subsequent rounds when the current investors choose not to make those investments? And maybe talk a little bit about why those choices might be made. And Rana, maybe I'll have you start this one.
So, it's an important point. I think that's something that we pride ourselves on. Pfizer Ventures has a history that precedes me, for many years. So I think the important thing here is that when we invested in a company, I think we really see the company through. It's not a matter of, if there's a strategic shift with Pfizer, we're going to walk away. We really know that we're in with the company and we want to continue to see that company through to success once we're in. And that, that generally means often, participating in future rounds. So it's something I think that is very important. I don't know, there are some instances where we've come across co-investors who aren't able to come into different future rounds. I think that there are reasons sometimes that make sense, and I think it doesn't always damage the company. So for example, a fund, it's common knowledge that a fund is, at the end of its cycle. And so it's not a decision that was made. It was just, money isn't available. So I think there are a little bit of nuances there in terms of why somebody isn't participating. Obviously, it helps the company to have the insiders participate and continue to support the company, through thick and thin. But I think there's room there to sometimes navigate that. Yeah.
I think the same is true for the institutional investors. And when we commit to a company, we're committing for the long term. We want to support that company over its life until it reaches a good exit. And so our intent always when we write that first check is that we will follow that up with future checks as well. And I've seen instances over the years where there is a scenario where an existing investor is not participating. And I think it's just something you have to figure out what the reason is behind it. And as Rana said, sometimes it can just be that maybe that fund is at the end of its life, or if they don't have the reserves remaining anymore, they're not in a position to do so. But you just want to make sure that it's not anything related to the investment itself.
So I'm going to kind of cap off. So we have a few more questions that are a bit different, but I do want, since we were going along this life cycle of the company here, I want to ask the kind of last question in that life cycle is, do you have a preferred way that you prefer your companies to exit out of, have an exit event, I should say. And Jason, let's start with you.
For sure, partner with Sanofi.
I was about to say, be acquired by J&J.
Okay.
For significant amounts so that we can recycle, give it to shareholders, then we're an evergreen fund and we can recycle it.
Great.
I mean, look, so the piece I'll add is, right, joking aside, right, I think if you look at the public markets, I mean, we've had 62 IPOs so far this year. I personally wouldn't have predicted the robustness given what the world looks like. I still view IPOs as a financing event. I think it does open up liquidity depending on how the stock moves. But ultimately, right, like I think it's, you know, great science and great technology that comes from great academic institutions will have the ability to be acquired or have additional financings that can provide liquidity in the public markets. And again, public markets and acquisitions it's been an incredible run the past 3-4 years.
Great, thank you. We have a couple of different questions, but I know, Stephanie, you had some questions still from the list of questions that we had received.
I do,
so
yeah.
Why don't you go for some of those, and then we can answer these other ones.
Sure. So since our audience, they are coming from the university side, many of them were curious to know how you prefer that universities reach out to you. If they have a technology that might be of interest, perhaps it's not actually a spin out yet, so something's still pretty early. Is it okay for folks to email directly, or do you think that a warm introduction from maybe a shared contact tends to work best? Marian, I'll have you kick this one off.
A warm introduction is always better. in part because if it's somebody like Jason who says, Marian, take a look at this, I'm going to take a look at it.
Yeah.
but I'm not, but I think, you know, we get so much inbound, and especially if it's something that's not coming from an entrepreneur or another VC, because you've heard, we're not as versed in sort of making the cake and baking it, if you know what I mean. So if it's really that compelling, it's much easier if it comes through already with a new co or an entrepreneur or a VC who's poking around to try and say, hey, is this a company I want to form? So you know, my recommendation is really to focus on VCs that are company builders and maybe smallish company builders or incubators and accelerators that can really help to put something together. I mean, we are investors in the Accelerator Life Science Partners that have New York and Seattle, Futurex based in Israel, but they take, by the way, I hope everyone's listening, they will form companies from IP from anywhere in the world. So FUTURX. So those kinds of vehicles, I think, are the ones that are most applicable if you have something coming in from an institution, at least for us.
And Rana, how about for you? The warm introduction is best?
A warm introduction is best. I think it helps fill in the picture of who, you know, how is this going to look. I think that's really helpful too. Yeah. If there are other investors. But also, I think even having, sorry, Stephanie, just, you know, having ongoing discussions also with tech transfer offices. I know that in our local community, you know, we're connected to our incubators and our all of that. And so it can be an ongoing discussion. It doesn't have to be and then it, you know, if you have that contact, then it's not a cold call.
Like if the call comes from John from Yale, then we'll take the call too, right?
He's saying he's calling you first? We're going to have to talk about that.
And I'll just quick mention that our university partners know this, but we are always happy to help with those introductions. So please feel free to reach out to us if we can help connect you to the right person. So for the next question, I think this is a really interesting one. So when you're looking at a university spinout with a license where the foundational tech is coming from that university, are there any aspects of that license that you would consider to be a deal breaker? And I'll have Marian kick this one off for us.
Yeah, I mean, I think, okay, one of them is it takes too long to license. I mean, I've heard multiple VCs say, don't even go to that institution because you're never going to get that license. Like, I worked for 18 months and never got that license, people will say, not me. So, you know, if you have, if you're have a reputation for not being able to be reasonable and rapid, that's a real problem. So that's number one. I think the other piece is realize that there is a huge amount of risk and capital that's going to go into making your idea into a commercialized drug. And so if you're talking about terms, upfront milestones, royalties that you think are going to be a big piece of that multi-billion-dollar drug, you're not realizing the fact that that little startup that is the one that is really taking a huge amount of risk and raising the money has to have space to have their own milestones, royalties. And then when the pharma comes, if those milestones and royalties that have already stacked up are unreasonable for them to make an M&A or BD deal, well, I mean, it's just what happens is the pharma says, I love this drug, but I can't commercialize it unless you go back and renegotiate with the university. So I would say, think about, the big game, and think about not being a barrier to all of the folks that are putting in the work. And by the way, the reason the pharma is saying that is they're the ones that are be paying $1 billion to take it through phase 3 development and commercialization, on top of what the little startup has done to try and create it into a successful biotech. So so those are some some advice in terms of looking at the big picture. And I know that because I've seen the struggles that the R&D folks have sometimes in terms of negotiating, the license from the startups that we invest in.
Can I just ask a quick follow-up on that? And Jason and Rana, maybe you can comment too on your experiences. But so someone asked about whether you have experiences with or opinions on express startup licenses that a number of universities have offered, any successful models or horror stories working with what's considered an express license, so a quick startup license. Anyone have an experience with those? No? Okay, well, so that's not going to be a very helpful.
Well, I mean, like, instead of express license, there's also the concept of like an option to negotiate an exclusive license. So that's oftentimes done if you're trying to get a license into a company, number that doesn't have any money, right? Because the option isn't worth as much as the license itself. So it's about capital saving, but then time saving. But then you also don't want to get to this point where you then can't negotiate the license, because that's a whole separate problem. But that's another. And maybe that's what the express license is, where you haven't worked out, let's say, all the nitty gritty, but sometimes the nitty gritty ends up being like very difficult to negotiate. And so the investors may come in and say, again, what's the probability that you might have a problem finalizing that? So, and another thing I would say is consider the additional license that may need to be taken, not just yours, if in the future some kind of IP pops out that company needs to license for freedom to operate. So yours might not be the only license, and so the notion of stacking provisions and things like that should be taken into consideration, or anti-stacking, I should say.
We had another follow-up question on options then, because options are used incredibly regularly with startups out of academic institutions, and it kind of depends on a lot of academic institutions' practices. But one of the things about options is they can be very fast to basically go over the line, get the company going and talking to investors, et cetera. When you see an option agreement, do you prefer to see the option with the terms attached if they've already negotiated it, and then they start talking with you, or would you prefer the terms not to be a part of the option and for you to be involved with those discussions? Anyone have any opinion on that?
Yeah, I guess I don't view it as a one-size-fits-all, right? I think it's really about how do you position companies for success. We did a seed this year where, effectively we put money in before the deal was signed. There was an option, but we had confidence because we had talked to the tech transfer office that where the direction it was going to go. But again, part of the seed was to full out piece and finalize the license agreement. So again, I don't think it's a one size fits all, but to me it's around, you know, how do you position companies for success, whether it's around valuation, whether it's around license terms, whether it's around knowing that the deal structure. But yeah, again, I don't think it's a one size fits all.
Yeah. That's helpful. We have a number of questions left, and I know that you guys actually have a hard stop, but we really appreciate your time that you were able to devote to this, and we will get to a few more questions, but I do want to let everyone know that we're not going to get to probably to everything because considering Jason, Marion's, and Rana's incredibly busy schedule, we were lucky to get them for the hour that we have. But I wanted to actually, if it's okay with you, I wanted to ask about something a little bit off of what we've talked about so far, and that's the importance of diversity and inclusion. And you know, what are the steps perhaps that you as corporate VCs have been looking at and taking with regards to closing these gaps with regarding funding for women and different racial and ethnic populations? So are there different initiatives that you have been looking at or already have in place for this?
Well, Jane,
yeah,
go ahead, Rana.
No, please, Mary. I was just going to say, you know, I think having it front of mind is really important. I think encouraging, you know, when we're invested in a company and sitting on the board, encouraging the companies to start pulling in people and really, you know, being aware of it on the board and management, you know, changing the profiles of companies, I think, and then you give people the experience, and I think it'll snowball once we allow those opportunities. I would also say that we are active in early mentoring and supporting other groups that are doing this externally. So, you know, Springboard is a women founders, you know, network, and I think that we're involved with them and a number of others like that. So kind of happy to support where we can also externally, people who already have these initiatives up and running. But I do think I really appreciate that you are bringing this up on the call, because I think it should be part of our conversation just every day. So.
Yeah, I mean, I think for us, our group is 50% women investors, you know, so I think creating role models it's a lot easier, I'd say, in the corporate world for women to become, you know, investors. And we at J&J obviously have a lot of diversity and inclusion efforts, and it's really in our culture. And so we try and bring those same practices into the boardroom and be a voice of diverse slates and advocates for first time, you know, independent board members, first time CEOs, and so I think it's an important time to be able to continue to bring other people along, and also to Rana's point, to help to create that slate, because you don't want to have the argument that that there aren't enough qualified people. And by the way, we do appreciate Jason joining to be the diversity for today.
Yeah. So I mean, I'm far from the most qualified to comment on this, but what I'll say is, I think it's a very important thing both for our CEO at Sanofi and our executive committee, as well as the ventures team. I think, to me, it starts with some data, right? So one of the things we've started to do is ask our portfolio companies, when you're hiring throughout the organization, both at the C level and down, are you pushing, for example, to your recruiters to have a certain percent of people of color or women, right? And the answer is, we want them to be able to go and say, we need X% in our candidate pools, and if you as a recruiter can't, you need to tell me why. As we think about independent board members, we're asking the same question, right? And so I think we're trying to roll out a couple different initiatives. And I was joking with Stephanie, you know, before this, I really appreciated that the panel was going to be well represented, whereas a lot of panels that one can be on where you don't have that type of gender or other diversity. And so I think it's little things of saying, look, if there's going to be a panel where it's going to be predominantly white males, I think being able to go and say, ask the group who's organizing it, I'm not sure I want to do this. Why don't we go and try to find some other people, or I can have one of the partners on my team, take instead of having me on it. And so I do think it's little steps we're taking, but I think we start with some of the data and facts within the portfolio companies, and then we go and try to provide as much of a framework that we think is important to make sure we try to bridge this, gender and DEI gap, because I think it's incredibly important, and we're far from where we should be or want to be. But I think it's questions like this, and I think it's us, trying to do the best that we can, and it's baby steps in that right direction.
That's fantastic. So we're coming up on 3 o'clock, and I know our panelists do have a hard stop. So I'm going to end with a couple of fun questions. So these can be just a quick yes or no, and we won't hold you to your answers. So for the first one, do you think that we will see a COVID-19 vaccine widely distributed in the first half of next year? Rana, how about the Pfizer take?
From the Pfizer take,
Yes,
I mean, I'm very optimistic, yes.
Yeah. Marianne, how about you?
Yeah, first half for sure.
Yeah. Jason?
No, I think it's, I mean, I guess you'd had to find widely distributed.
Widely, widely is that
true.
I think when Sanofi's comes online, the middle of next year to
I'd say June. Yeah, I'm thinking June.
Okay. Good. Well, I'm certainly looking forward to getting back into the office and seeing my colleagues and all of the folks in tech transfer. So I can't wait for that to happen. How about with the IPO markets? Will the hot streak continue in 2021? Jason, what do you think?
Yes.
Yeah.
Yes.
Marianne? Rana?
I'd
Yeah,
say first half.
Yeah.
With a preference for Osage investments, I think that's going to outweigh most of the.
Thank you. I appreciate
most
that.
of the companies on public.
And then the last one. So I heard that Philly is putting lockdown restrictions back in place this Friday, and so I need some ideas. Favorite TV show? What should I be watching? Marianne?
Oh, that's a tough one. That's a tough one. I have to pass on that one.
All right. Rana or Jason?
I'd say Schitt's Creek if you haven't seen it.
Oh, I
had
haven't.
fun.
Okay.
I have a 3 to 5 year old right now, and so I think that's been the primary focus in
okay.
TV time. A new episode or season of The Crown, I think, just came out.
Oh,
so,
right, yeah.
I haven't watched it, but I know that's on our. Unlike people who binge watch, we take one show and we try to get through it over like a week, so we get 10 or 15 minutes at a sitting. So
Supernatural is kind of a weird one. That's old.
Great. Well, so with that, we're at the top of the hour and we've reached the end of our webinar. We do want to collect feedback, so you'll see that a link to a survey has popped up in the chat box. So if you could fill that out, we would really appreciate it. We really do review all of the responses and we use them to improve our future webinars. So Jason, Marianne, and Rana, thank you so much for your time and shared expertise today. And thank you to our audience for all of your questions. And also thank you to Natasha. None of you can see her because she's the OUP logo, but she is the person behind all of this who keeps things running for us, which we certainly appreciate. So stay safe, stay healthy, and we hope to see you on another webinar soon. Enjoy the rest of your day.
Thank you, Stephanie. Kirsten,
Thank you.
thank you much.
Thank
Rana,
you.
Marianne.
That's great.
Good to see you.
Yeah, good to see you
Thanks.
guys too.